All right, good afternoon, everyone. Let me check first that you can hear me well. Yes, you can. Good, that's very good. All right, so let us start the teaching for today. So, I remind you that today is our next to last class. We will have class today and tomorrow. So let me briefly explain to you how we will proceed for those last two classes. So today we're going to work on this section 5, which is about international trade and international finance. So we're going to try to open up a little bit what we've done to take into account the rest of the world, right? And tomorrow we'll do several things. So first of all, we'll do a practice exam, right? So the mock exam. Okay. So this will not count towards your final grade, right? It is just to practice. So there will be at least some MCQ questions, some multiple choice question. There might be an exercise as well with balance sheets, right? Because we've done quite a few of them, so it would be perhaps interesting for you to practice this in case you get some at the exam. So I'm not quite sure yet about the format. So that's for you're gonna have some multiple choice question. That's for sure. That I'm going to answer with you after you spend some time trying to figure out the answers and perhaps an exercise. Okay, so we're gonna do that. The other thing I would like to do tomorrow is for you to prepare questions on what we have done so far. Okay, because tomorrow is your last class, it's your last chance in a sense uh, ask me to clarify some points or to come back on something that you did not really understood, um, some clarification. So I think it would be nice if you could do that. Prepare a couple of questions. If you don't have questions, that's fine, but you may have questions that are related to the topic that we've studied. And finally, tomorrow we're going to study topic 6 on the Vietnamese economy. Right? So we're going to try to have a look using mostly what the IMF has produced. As you probably know, every other year the IMF produces what we call the Article 4 study, which is about an in-depth study of the macroeconomic environment in Vietnam. So we're going to look at that. I think it's interesting to put some perspective on how the Vietnam is doing at the moment and over the past few years. Okay, so to summarize, tomorrow it's going to be a busy session. We're going to have a mock exam. We're going to have some Q&A session, and finally we're going to study topic 6. Okay. As for today, well, unless you, so as for today, we're going to proceed as I usually do. So we will, first of all, so I'm moving to share notes. Let me shift that into English because it's in French by default, apparently. All right. So we are going to do as we usually do. That is, I'm going to provide a short summary of what we did on Saturday. Saturday was a big session, right? We had morning and afternoon session. So let me try to summarize what we did. So first of all, because on Friday we studied the 2008 financial crisis, which was a great financial crisis. That was on Friday. On Saturday morning, we talk about the euro crisis, right? And I told you there are several issues with the euro. The problem is that you have different countries with productivity growing at different rates, thereby translating into varying growth rates in production costs. Before the euro, this was solved via currency depreciation for southern European countries with higher growth rates of labor costs. And that is not possible anymore. Meaning southern European countries are losing ground in terms of competitiveness. Okay, that's the first problem, and that's the main problem actually. So, second problem that we've seen is the fact that between 2000 and 2010, roughly, all European countries had the same linear interest rate, which represented a huge drop in borrowing costs for most southern European countries, which they took advantage of, right? Translating into high private and public debt to GDP ratio. Third, we realize that the eurozone is unlikely to be an optimal currency area. And finally, that we have a one size fits all policy, not suited to many countries. All right, so that's what we discussed about the euro, with the main conclusion being that euro is clumsy common currency with potential new crisis. It was important for you to know a bit more about this, and I've worked in the past quite a bit on the euro, so I know a bit about the situation, and I think as people that are that are working in banking, perhaps in investment, in the banking in the banking sector in one important Asian country, then you need to know what's going on. You need to understand what's going on. Okay? That you're not surprised if this problem comes back at the forefront. Okay. So then we move to section 4. and looking at alternatives to the current monetary system. Right? First one was free banking. You know very well what that is now. Free banking, right? Free banking is same system as today, without. Okay. So in this environment, banks can pay each other option with some reserve asset, not base money, because you don't have base money. That could be gold, could be bonds, securities, whatever. Okay. They can pay with their own money. Okay, we had an exercise about this where Bank B was paying by issuing its own liability. And we know that in Vietnam, you're already doing some of that after 3 p.m. using the Post One Store account. And finally, banks can pay with, I put it, with the currency. Yes, the currency from issued currency reserves from currency this environment banks can pay with some reserve asset with their own money or with the money issued by other banks and that they have accumulated. Right? You remember in the exercise, Bank B could pay with Bank B's money, but it also could pay with Bank A's currency that it had accumulated. Okay. So because there is no central bank, there is no lender in last resort. This could be a problem. Unless banks pay into an insurance fund, right? That would be activated in case one bank is in trouble. Okay. And finally, I told you that it exists. We have quite a few examples in history of free banking, and it was not especially unstable, contrary to popular beliefs. And my view is that it would be quite easy to implement nowadays with the information technology we can use. Right? Thing is, there's going to be a lot of resistance from the central bank because they would be losing their monopoly on the reserve asset. So you can understand quite easily why they are very reluctant moving in this direction. Okay, so that's the first alternative. The second one that we studied was cryptocurrency. Cryptocurrencies, and in particular, we talked a lot about Bitcoin. Right? Talked only about Bitcoin. Actually, I just mentioned some other ones, but it's the first one, the most important one. Actually, an interesting thing to realize that Bitcoin is like the US dollar of the other cryptocurrencies. If you look at the foreign exchange market, most currencies exchange rate are expressed against the US dollar, like it's the core currency of the foreign exchange market. In the cryptocurrency world, Bitcoin is like the US dollar. So every single cryptocurrencies is priced against the Bitcoin. Their prices tend to move together. And one of my students made a master thesis on that topic and showed that most cryptocurrency prices tend to move together and are highly correlated with Bitcoin prices, but still, it's not always the case, but it happens. Okay. So what did we learn about Bitcoin? We learned that it relies on a highly decentralized network of linked computers running the Bitcoin software algorithm. Right? People taking part in this process have a chance to earn Bitcoin priced around USD 19,000. People taking part in this process have a chance to earn Bitcoins if they manage to be the first to able to validate transactions and add them to the blockchain. Okay. The important thing is to understand is that it's very different in the way the current monetary system works, because in any country it's very centralized. Transactions go through your bank first, and then everything is sort of netted within the central bank, and then moves back to the bank and moves back to your account. With the crypto, in the crypto world, there's no need for a centralized body. There's no need for some monopoly power. There's just this decentralized network of computers that run the Bitcoin system live in real time and make sure that everything is consistent. And every time there is someone trying to twist the history, because Bitcoin is nothing but a huge history book of past transactions. Every time someone tries to twist this book, there's an error message or something like that that lets you know that you're trying to cheat with history. You cannot rewrite history. So that's how the system works, and makes sure that no false Bitcoin can be forged. And something that is important to realize, and I remember you asking a couple of questions about that, is that the new Bitcoins, someone asked an interesting question: who gives the Bitcoin? The new Bitcoin, right? It's the computer, the algorithm, right? The algorithm of the software rewards, right? It's not a physical person. It's not a legal entity. It's just the computer code that credits your account if you manage to win those. I think it's 6.25 bitcoins price every time you come up with the right ID number. Okay. So I guess that's what we did on Saturday. So I'm going to move back to the public chat now, and I'm happy to take questions on what we did, perhaps before we move on. All right, it looks like there's no questions, so we're going to start section 5 then. So section 5 is somehow about, I want to talk also about international finance, right? We've talked a lot about money creation, monetary policy, but we somehow stayed within the confines of the domestic economy, right? What I would like in this section 5 is to open up a little bit to international finance, and in order in particular to study exchange rates, right? Because this is an important part of the monetary environment, that is the price of the domestic currency with respect to the other currencies in the world. So that's what we're going to do today. We're going to spend quite a bit of time trying to explain why currency fluctuates on the foreign exchange market. What are the main determinants of exchange rate, right? But before doing that, we need to have some sort of framework of why do we need this foreign exchange market, and that's very much related to international trade. So that's why I'm going to provide some sort of reminder for many of you, perhaps. Maybe some of you have not much studied international trade, but we're going to start looking at international trade, some patterns with some data on Vietnam, then move to international finance and exchange rate determination. Okay. All right. So this is the plan for today. So we're going to start with some introduction and definition. I'm going to give you some data on how international trade has evolved over the last century, and even before that. Then we're going to look at the determinants of international trade. Right? We're going to see in particular that Vietnam is one of the most open economy, if not the most open. Is one of the most open economy in the world. Openness being measured by the ratio of exports plus imports divided by GDP, right? So X is exports, M is imports, and Y is GDP. In Vietnam, this ratio here, this particular ratio is equal to 200%, right? So I've looked at the last figures. Exports about 108% of Vietnamese GDP, and imports is 103% of the Vietnamese GDP. So you see, if you add the two of them, you have like 211%. So it's a very high ratio. It's one of the highest in the world. That means there's a lot of trade, international trade going on in Vietnam. This is a unique feature of the Vietnamese economy. This is a good feature. So we're going to talk about that. So then we're going to look at protectionism in international trade restriction. That's also something to look at when you talk about trade. And finally, as I said, we're going to spend quite a bit of time talking about the exchange rate determination. It's important to understand how your currency fluctuates and why. Okay. All right, introduction and definitions. So we're going to start with some basic. Imports are the goods and services that we buy from people in other countries. So in Vietnam, that would be mostly cars. Not mostly, but cars is basically the sort of good that you're buying from the rest of the world, and you're exporting a lot of things like garment, electronics, and so on. And exports corresponds to the goods and services that we sell to people in other countries. What is a trade deficit? A trade deficit is a situation in which net exports are negative, which means the country is importing more goods than it is exporting, right? And you have several countries in this situation. France, for instance, but the USA and Australia. They tend year after year to import more goods than they are exporting goods. This has not always been the case. I'm going to show you some statistics about the USA. You're going to see that things started to drift around the 80s. It's about the same for France, actually, which for a very long time was a net exporter. A trade surplus is the opposite situation, is a situation in which your exports are greater than your imports. Okay. Typically, a very famous country for that is China, but Japan is in the same position, and so is Germany. Okay, when these countries they're exporting a lot of goods to the rest of the world. Then we give you some statistics. For instance, China every year exports about $600 billion worth of goods and services to the US, whereas the US exports only about 200, 250 billion US dollars to China. So we're talking about a 400, 350 billion US dollar trade surplus for China with the US alone. Okay, China tends to run the trade surplus with most countries. And finally, we have balanced trade, which is a situation in which net exports are zero, which somehow exports and imports are equal. That's somehow the situation in Vietnam, right? At the Vietnam is in that situation. That's balanced trade. I told you the last figures is a little bit more export than imports, but it depends on the year. It's not over the last 10 years. It's been roughly balanced. Okay. All right, some statistics here. So this is for the USA. Oops, yes. So the sort of green bluish line is the imports as a percentage of GDP, right? And the red curve is exports. So as you can see, they were pretty flat, around 5% of GDP. Then things started to increase. I'm going to change the color because we already have red there. And it started to increase roughly the beginning of the 70s. Then roughly flat, but the inflection point was around here, right? For the US, as I told you, early mid 80s. Suddenly, we had a lot more imports than exports. Okay, and since the mid 80s, the USA has been running um, a trade deficit. Okay. If we look at Vietnam, for instance, so this graph stops in 2015, but again, I'm going to give you some more recent figures probably tomorrow. But as you can see, it's a lot more than in US, right? If you look at the US, it started at 5% and it's between 10 and 15, 10% for exports, 15, 13% for imports as a percentage of GDP. For Vietnam, it's way above that, okay? Because each of them is roughly around. Um, oh no, that's not percentage of GDP. That's in value. But I'm going to give you um, the the percent as a percentage of GDP in a moment, right? So you'll be able to see what that is. But yeah, so if you look at the Vietnamese GDP, for instance, it's around 280 US dollars. So you can see it's about half, as I was saying. So what are the factors that affect net exports, right? The determinants of international trade. We're gonna start by some basics. So first of all, the tastes of customers, right? That's that may sound a bit obvious, but that's important. For instance, people like German cars. They are considered as a good, nicely built, reliable cars. So
exactly.
people
In
like
North,
German cars, so they're going to buy
North
German cars. So that's
Malaysia,
going to contribute to increase Germany's exports and imports from other countries, non-German countries. The second determinant is the price of goods at home and abroad. So, for instance, so people like German cars, obviously, but the Korean cars are cheaper. So, a German car is very nice, but it's also very expensive. So maybe I'm just going to buy a Korean car instead, which is very nice too. Perhaps not as good as Germany is, but they're very good too. So my point is, yes, preferences or taste are important. But for instance, I like Ferraris. Not sure I can afford to buy one. Okay, so everybody likes Ferraris. So it's not only the taste of customers that matters. It's also the price of those goods. Okay. The exchange rate as well plays a very important role. For instance, if you are thinking about a Korean car, you would be paying attention to the exchange rate of the Korean currency. Who can tell me what's the name of the Korean currency, please? You know the name of the Korean currency? Yes, the Korean won. That's exactly that. So it's the won. Okay. So assume, for instance, that the Korean currency appreciates, right? But that's mechanically going to make a Korean car more expensive. So this is going to impact on the demand for Korean car in Vietnam. Okay, so that's why exchange rates are playing an important role in net export. Remember, net exports is equal to the difference between exports and imports. Okay. To summarize on this slide, the main determinant of international trade as measured by net export is the taste of customers. Oops. Taste of customers, the price of goods at home and abroad, and the exchange rate. Okay. What else is important? Well, incomes, obviously. Okay. To buy goods from the rest of the world, you need to have the means to do that. Okay. For instance, if you look at the US situation, the US has been running a large trade deficit for since the mid 80s. Well, one reason why they are able to run such large trade deficits is because they have the incomes to pay for those imports. Okay, the GDP per capita, the average GDP per capita in the US is pretty high. We're talking 55, 60,000 US dollars on average per person per year. So that gives room for a lot of spending coming from the rest of the world. By contrast, if you take a country like Sudan, which is a new country, but it's very poor, talking about a few dollars per year as it's a very poor country. In a country like South Sudan, of course, they're not going to be running a big trade deficit, right? Because they are too poor. Okay, they are so poor they cannot afford anything or very little coming from the rest of the world. Okay, so that's why you need to keep that in mind. Okay, incomes are key determinants from net exports. For instance, China at the moment is running a huge trade surplus, while as their income grow, as their currency appreciates, little by little, this trade surplus is going to shrink, and they might move back to some sort of balanced trade or even some sort of trade deficit if they enjoy buying goods from the rest of the world. For instance, we have a lot of Chinese tourists in France. This is considered to be an import, right, for China because they're buying tourist services from some other country. So, all right. Transportation costs are also a key determinant in net exports, right? I'm going to show you some statistics. Is it next slide? Yes, I think it's coming soon. I'm going to show you some statistics about the huge, massive drop in transportation cost, whether we're talking airline, sea freight, or information over the 20th century. It's pretty impressive, right? And obviously, this contributed to boost international trade and therefore net exports. Government policies, obviously, are playing an important role in international trade. You can make international trade more or less easy, right? You can make it difficult by putting some quotas, some tariffs. some compulsory health regulations to be met. That's going to make life difficult for people that are trying to import goods in your country. And on the others, but others, or you could make their life very easy by reducing all those what we call trade barriers, right? Obstacles, hurdles, everything that makes the life of exporters and importers difficult. So governments do have a role, do have an impact in the amount of international trade. Okay, we're going to come back on this. And finally, another determinant of international trade is the presence of natural resources. Okay? Um, you have a lot of countries like I don't know, Saudi Arabia, okay, Kuwait. They have a lot of oil, right? A country like Indonesia. Do you know what Indonesia is the world top exporter of? Indonesia exports one big commodity. Do you know what that is? It's a world top exporter in one particular commodity. You know which one? Exactly, coal. Indonesia is the world first coal exporter. It's steam coal for heat producing, for energy producing. Okay, so these countries, obviously, because of their natural resources, they are somehow influenced in their international trade structure. Right? Indonesia would be exporting a lot of coal, just like Australia, by the way. Australia is also exporting coal. It's a different type of coal. It's more like what we call coking coal, which you use into to produce metal, um, etc., etc. Okay. So to summarize, to have some sort of bird's eye view of the determinants of international trade, um, we have first of all tastes, preferences, prices of goods, exchange rates, which we're going to talk about later, incomes, transportation costs, government policies, and natural resources. Right, those are the main determinants of international trade. So if we look at the situation in Vietnam, for instance, um, well, I'm going to show you some statistics about the sort of good that Vietnam exports. Right, I'm going to do that later. Some data. So let us start with trade globalization since 1500. So what do we have on the vertical axis here? So shown is the sum of world exports and imports as a share of world GDP. So this is the statistics that I mentioned at the beginning. We have x plus m divided by y. This is what you have on, oops, on the vertical axis right there. And on a horizontal axis, you have time, starting from 1500 up to 2011. And this is for the world, the entire world. Okay. And what do we see? Well, we see that the ratio of export plus import divided by GDP, which is some sort of indicator of international trade, was below 10%, rising slowly up into the Industrial Revolution. And then, as you can see, a massive increase starting from the second half of the 20th century. Okay, I'm going to write that here. A massive increase in the x plus m divided by y ratio since after World War II. There was a bit of an increase before World War II, but there was a short period of heavy protectionism in the 1930s, right, in which this index of international trade dropped from 30% to nearly 10%. and then it went back up right after World War II very heavy, and now we're talking 60%, right? But keep in mind, in Vietnam, that ratio is 200%, so it's about it's more than 3 times the world average. Okay, but I'm going to explain why it's so high in Vietnam and why it's so low in the US in a moment. But the big picture is the following: very slow growth, some pickup up until World War One, then a dramatic fall because of protectionist measures that were taken by many countries, especially in the US in the 1930s. And after World War II, a huge expansion in international trade. Okay, and now we've been sitting around that 60% mark since then. I'm going to explain to you in a moment where this is all coming from. You're going to see there are mainly two reasons. So now we take a closer look. This is world imports only, so the ratio here, but it's m divided by y. It gives you the same ID, right? So as I was saying, so there was some sort of increase. Oops. Some sort of increase up until sometimes around World War One. Then it fell, and then an increase again. Okay. Just to give you some sort of illustration of the impact, the importance of international trade, I thought I should show you this picture. It's a Boeing Dreamliner aircraft from Boeing. And as you can see, it's not really made in the US, right? The doors are from France, the cargo access from Sweden, the landing gear from France, the fuselage from the US and Japan, the engines from the US and the UK, thrust reversers from Mexico, the batteries from the US. It's coming from all over the world. The tail fin from the US, wingtips from South Korea. So that's international trade. You see, that big Boeing is actually made of a lot of components that are being manufactured all around the world. Okay. When we talk international trade, something that's important to keep in mind is the importance of sea freight. Right? Sea freight. Because 90% of goods exported end up on a boat at some point. So what is interesting on this map is you have, first of all, the dots here, the black dots represent the ports, okay, maritime ports for goods shipping and trafficking. So the bigger the dots, the most important the port. So as you can see, in Asia, Singapore is one of the biggest ports. Then you have a lot along the Chinese coast. Okay, here is Vietnam. And you have also the trading routes, right? It's pretty amazing, right? Those are the blue lines. There's a lot of traffic here between Europe and the US. A lot of traffic in Asia along the Asian coast. I don't know, maybe some of you had the chance to fly to Singapore, but I remember doing that, and the plane was making cycle above Singapore, waiting for a time slot to land, and we were flying above the Singapore Bay, and well, like a lot of ships waiting to enter the port and to cargo. So that's pretty impressive. Something else that is interesting to realize that there's not much going on in Africa, especially the southern part, because it goes along its coast there, and same for South America, right? All right, so again, let's go back to our favorite statistics, which is x plus m divided by y. We're going to call trade as a percentage of GDP. So trade is, we know that, the sum of exports and imports of goods and services measured as a share of gross domestic product. So here I'm starting from 1960, so I'm taking an even closer time range. In the world, it started around 25%, and now, as I told you, we're about 60%, right? So in a matter of 50 years only, that percentage more than doubled. So it's pretty impressive, right? Now what we're going to do is going to look by regions. That's the next slide. And what can we see? Well, we can see that, for instance, this is the USA. It's sitting at 20%, so it is below the world average. And on the other side, you have the European Union, which is sitting above the world average. And then you have East Asian Pacific at about the world average, and then Latin America. Okay. If we look at some particular countries, that's the United States. This is Germany. I told you Germany exports a lot of goods. And then you have France and the UK, which are about the same at around the world average. But as you can see, Germany is way above the world average, and the US is way below the world average. Let's have a look at some ranking now. Vietnam, here it is. So again, it's the same statistics, right? Trade as a percentage of GDP. So it is always is X plus M, export plus imports divided by GDP. Okay, so as you can see, Vietnam is nearly, yeah, so which date is that? I think it's, let me try to figure that out. I'm trying to find the exact date. I think it's a couple of years ago, perhaps 2017. I'm going to give you the exact date in a minute. No, I'm not. Well, I think it's about 2017, I would say. So, as you can see, Vietnam is one of the most open economy in the world. What else? What other countries do we have in front of Vietnam? We have very small countries like Singapore and Luxembourg. Okay. So, in terms of a large economy with a very populated country, and in Vietnam, you guys are getting close to 100 million people. So it's a big country, right? Nothing comparable to Luxembourg or Vietnam or Singapore. Vietnam, among the big, let's call it big countries, is probably the most open of all big countries, right? So then you have France, a bit above the world average. Then you have the world average here in black, a little bit above 60%, you can see. Around 60%, that's the 50% mark. And that's the United States here, right there. Okay. So before, and let's have a look at some more statistics, and I'm going to come back on this slide. This is again trade as percentage of GDP, and I'm comparing various different Asian countries. Look at that. So in Vietnam, you had some big reform, right? In 1987, moving towards more free market economy, right? Less centrally played. A lot more freedom for business. As you can see, this had a huge impact, right? Because you went straight from 20% to nearly 200%. Okay, but as you can see, China and Vietnam, China and India, it's a different story, right? It has increased a bit, but it's still around the 40% mark, which is below the world average. So now I would like to ask you one question. Why is that a country like the US has a low X plus M divided by Y ratio? In your view, would explain this? As you can see, it's pretty Uh, if you look at this graph here, it's pretty small, right? It's way below the world average. So any idea was why a country like the US has a very low ratio? Perhaps to help you answer, it's about the same situation in China and India, right? It's a relatively low ratio. Do you know why? Do you have any idea why? And by contrast, a country like Luxembourg and Singapore, they have very high ratio. Why is that? You can see someone is typing. Even two people. Because they have large GDP. Big international market. Well, neither of those answers are the best answers, I would say. Um, think about what example could I do? Uh, I guess the first one is somehow related to the correct answer because they have large GDP. Um, actually, the idea is the following: when you're a big country like the US, when it's very large, you have a lot of people. Well, people in this country are already producing a lot of the goods that they need, right? They're already producing cars, they're already producing all sorts of services, they're producing motorbikes, they're producing leather jackets, electronics, they're producing a lot of stuff already. So, because it's a large economy, because there are a lot of people, right? By contrast, if you think about Luxembourg or Singapore, those are very tiny countries. You don't have many people living there, right? So you will not have an aircraft manufacturer in Luxembourg. You will not have a car company in Luxembourg because those countries are too small for this sort of industry, right? So the smaller the country, the less likely you are to have everything being produced at home because it's too small. For instance, in a lot of industries, you need economies of scale, right? That means you need to produce a lot of the goods to be able to decrease the cost per unit. So if your economy is too small, there's not much incentive to produce those goods, right? So to summarize, that's the main reason. Very large countries like the US, but also China and also India, because they are very big, a lot of people, there are a lot of different industries, a lot of different services that are being produced. Therefore, they need less imports because, in a sense, everything is already produced at home. Everything, nearly everything, is already produced at home. But that is not the case for Luxembourg. Luxembourg is too small, so that's the main reason. So you see, it's interesting because even for China, and we know China is a big exporter, right? It's the world's first exporter. But even though it is the world's first exporter, its trade ratio is not even at 40%, right? Which is below the world average, which is at 60%. And how do we explain that? Precisely because it's such a big country that they're already producing a lot of the goods that they need, right? I mean, outside of aircraft, I'm not sure what is it that China doesn't produce. They're already producing their bullet train, they're already producing cars, motorcycles. So yeah. As for the situation in Vietnam, it's a bit particular because, as I was saying, it's not a small country by any means, right? 100 million person. But it's just, I don't know, it's just the way it is, right? That you guys are used to trade, to buy from the rest of the world and to sell to the rest of the world, and that's your way of life. Or I don't know, maybe trade barriers are low, so that's uh, that's an interesting thing to notice. Okay. So, do you have any question at this stage before we move on, trying to explain why this international trade has increased so much in the 20th century? or maybe a question or a comment. We're not going to do many exercises today. I'm not even sure we're going to do one. So it would be fun and nice if you guys could throw a question from time to time or a comment, because we won't have much opportunities to interact if there are no exercises. I can see someone is typing. Temporary import for re-export may be the cause of large trade in Vietnam and Singapore. That's definitely possible. I know that's the case in Switzerland, for instance. I don't have the figures for Switzerland, but there's a lot of this sort of thing, so that they're importing and re-exporting immediately. So, but technically, the goods do not even touch the Swiss territory, right? It's just all virtual. So there might be this sort of thing going on for Singapore, perhaps for Vietnam as well. I'm not sure. I'm going to show you some data for uh, for Vietnam, and you're going to see that there are some real imports. It's not only accounting procedures in a sense, right? And also in some of those tiny countries are exporting a lot of financial services, so that would boost their figures as well. So yeah, good comment. Thank you for that. For instance, I think if you look at you're welcome. If you look at Switzerland, it's the kind of one of the main gold exporter. I've read that somewhere. I need to check it, but it seems to me that I read it. But there's no gold production in Switzerland, right? But they're importing it, at least on paper, and re-exporting it immediately. So because you have a lot of commodity traders, businesses that are located in Switzerland. So they buy commodities, they resell it immediately. So this would count toward export, but that's not really export. But I don't know of anyone digging for gold in Switzerland. I don't think so. But good comment, thank you. Any other comment or question? I can see someone is typing. What happened in 1988 in Vietnam that boosted the trade? Well, you had some big market reform, right? In economic reform in Vietnam in 1987, right? Or 88, I think. Um, but I'm sure perhaps someone can answer that question because you probably know more about Vietnamese economic history than I do. But I think around the late 90s, there was some big transition from a socialist economy to a more open market oriented economy. So that suddenly made it possible for Vietnamese businesses and households to import and export easily, right? So I'm sure that that contributed to this big spike. You can see that someone is typing, so perhaps we'll have a more precise answer. Yes, that's the Doi Moi policy was officially implemented since the Sixth Congress of the Vietnamese Community. Yeah, so that's 1986, right? You can look it up on Wikipedia. I have it in front of me, right? Doi Moi. I'm probably not pronouncing it right, so please excuse me. Is a name given to the economic reforms initiated in Vietnam in 1986 with the goal of creating a socialist-oriented market economy, right? The Doi Moi itself is a general term with wide use in Vietnamese language. All right. So that's where it's coming from. Doi moi means change. Okay. I hope my pronunciation is okay. Probably not. Okay. All right. Yes, thanks for answering the question. All right, so let's move to the next slide because we need to explain a little bit what happened in the world, in particular this slide. Okay, what happens here? You see, this is massive, right? This is really huge. It's even more spectacular for Vietnam, but all right. So if you want to understand why do so this has changed the face of the US from an economic point of view. Okay, there's a lot more international trade, a lot more globalization in the world than 50 years ago, and I'm not even talking about 100 years ago. Things have changed dramatically, right? A lot more international trade. Where is this coming from? So we know in Vietnam you had this change, this doi moi policy that played a big role. And you're going to see that we had something similar at the world level in a sense that there were one of the two big reasons I told you was actually policy implementation of free trade. I'm going to talk about that. But before that, the first thing to realize is that there was a huge drop of transportation costs in the world thanks to productivity gain. So look at this graph. We're starting in 1930 up until 2005. Okay. In green, you have sea freight cost. Remember sea freight? This is the cost of moving goods around um, like this. Okay. If so, everything is normalized to 100% in 1930. So if in 1930 it was costing $100 to ship goods around the world, now it's costing only $20. So it's an 80% fall in sea freight transportation costs. So that's massive. So obviously, that makes international trade a lot easier when you have an 80% drop in sea freight costs, right? And remember, sea freight is 90% of all exports. If you look at passenger air transportation costs, it has fallen from 100% to 10, it's only 10% of what it was back in the 1930s. So it's even more spectacular. The cost of air transportation has fallen by 90%. Right? That's also something to keep in mind. I'm sure some of you have already traveled abroad by plane. Well, I remember during my parents' generation when they were young, air travel was very expensive, a lot more expensive than it was today. It was really um, some sort of opportunity that was only accessible for rich people in a sense, right? And even more spectacular is that's the blue line here. It's international calling cost. So we're talking about communication cost in a sense, right? And communication is important for services, for instance. Communication costs. So again, if you look at in the 1930s, if it was costing $100 to send information around the world, now it's costing nearly zero. I mean, look at what we're doing now, right? I'm sending information from France to Vietnam, and it's pretty much zero the cost of transporting this information through the web. Okay, there was nothing like this that was possible in 1930. Okay, so my point is, if you want to understand this huge increase in international trade, well, there you have your first answer. Right? A spectacular falls in transportation cost, whether we're talking sea transport, air transport, and communication cost. So transporting data, if you want. Okay, pretty spectacular, right? So it cannot fall any further, those international calling costs, right? Second reason, I told you the first reason is foreign transportation costs. The second reason is political, in the sense that up until the 1930s, and it actually peaked in the 1930s, you had the average tariff in the world was pretty high. What is a tariff? Do you know what a tariff is? Yes. And what is it? How would you describe a tariff? Yes, it's a barrier, but can you be more specific, please? I can see that you are typing, so I'm waiting for the answer. Maximum of goods and services you can import. Nope, it's not exactly that. What you're describing, Mrs., is a quota. Okay. A quota, so I'm going to write the definition of both actually. So a tariff is a tax on imports. As simple as that. Right? Tariff is a tax on imports. Okay. What you were describing was a quota. A quota is a cap, a maximum. Big enough. Do that. A quota, a cap, or maximum amount on imports. All right. Exactly, maximum quantity of goods imported, right? So those are the two main tools for protectionism, right? Uh, Typically, government, when they want to use protectionist measures, they use either tariffs or quotas. Okay. And here on this graph, what is it that you have? Well, let's read this. Chart 12, the 19th. So actually here on you have the average tariff in the world. So the average tax on imports in the world. Okay. So back in the 1930s, it was about 23%, right? So that's huge. I mean, you had an average 23% tax on every single good that was imported. So that makes things very difficult for importers, right, and for international trade. So what happened is that economists and managed to convince policymakers and governments around the world that this was very bad for growth, this was very bad for well-being, for prosperity, and that international trade should be boosted. And how can you do that? Well, you should just decrease the average tariff, right? And that's what happened. So you had a lot of what we called uh, trade discussion rounds, like the Uruguay round. Have you heard about the Uruguay round, for instance? Uruguay. So a bunch of talks, meetings, and discussions between world governments to agree to decrease the tariffs that they were applying to imports coming into their country. Okay, because that's the thing about tariffs, right? You don't want to be the first one to decrease your tariff, because if you're the only country with no tariff, that means other countries can export into your country because there's no tariff. But if they keep their tariff, then you will not be able to export into their country. So if you want to decrease tariffs at the world level, the only way to proceed is to have uh, international rounds of discussion, right? In order to agree to decrease. So international rounds of discussion to agree on decreasing tariffs. So as you can see, it was massive, right? In 2012, the average tariff in the world was now at around 3%. So it's a 20% drop from the 1930s. So huge drop as well. Okay. So if you combine these two graphs, which by the way both have the starting point in 1930 in here, as you can see, huge drop in transportation cost, huge drop in the average tariffs. Okay, so that explains why um, we had such a boost to international trade. Okay. All right. Type of goods traded internationally. So we're starting 1900 to 2011. If you look at the beginning of the 20th century, uh, it was mostly agricultural products that were traded. Okay. With some manufactured good and a tiny portion of fuels and other mining projects. Okay. And if you look at the trend over the 20th century, it's all up for manufactured goods and all down for agricultural products, and also an increase, as you can see, in the quantity of fuels and mining products that are being exported. So an interesting change, interesting developments in the types of goods that are now traded internationally. It used to be the majority, 57% was agricultural product. Now it's fallen to 9%. So a much smaller fraction of international trade is related to agriculture. However, you have a bigger, because it increased by 50% in share, a big increase in manufactured goods from 40% to 65%, and most spectacular perhaps is an increase in fuels and mining products from 3% to 22%. Okay, so that's also something to keep in mind, a change in the pattern of international trade. Next slide. So what is that? So this is a very interesting website, by the way. It's from the MIT. Do you know the MIT? It's the Massachusetts Institute of Technology. It's one of the best universities in the US, located in Boston, Massachusetts. And they have produced this very interesting website called the Observatory of Economic Complexity, which I strongly recommend, and on which you can find, for instance, this sort of graph in which you would have exports by countries and by type of goods. So here I'm just export for the world taken as a whole. So as you can see, a lot of which is electronics, right? This is the blue. Then you have everything that's related to transport, cars, vehicle parts. Then you have medicaments and medicine. Then you have energy, petrol and oil. This is all mining stuff here. What else do we have? Here we have everything that's related to chemistry, gold, and this is all agricultural project. As you can see, it's much smaller than it used to be. Okay, and everything. Okay, so very interesting to look at, because you can look up every country. For instance, you can look up at Vietnam. This is the export patterns of Vietnam. As you can see, nearly half of it now is related to electronics, broadcasting equipment, telephones, computers, integrated circuits. The rest is garment and clothes. okay, knitwears, footwear, and so on. Some agricultural products, coffee. Vietnamese coffee is really good. Actually, every time I go to Vietnam, I bring back for 1 year consumption of coffee. And this year I could not do that. Fortunately, I found a place in France that imports coffee from Vietnam, so I'm safe for 1 year. I think Vietnamese coffee is really good. I don't know what you put into it, but it's really good. So that's Vietnamese export, right? This is France. So a lot of stuff related to vehicles and spacecraft. Uh, you can have wine, obviously. Okay. This is Côte d'Ivoire, an interesting country to look at. Why? Because it's representative of many developing countries, relatively poor developing countries, especially in Africa, where, as you can see, they're exporting mostly agricultural products. Okay? I'm going to write that here. A lot of relatively poor countries, especially in Africa, are commodity and in particular agricultural are commodity exporting countries. Okay, the problem is there is not much value added in commodity products. Okay, so that's why you guys in Vietnam are doing the right thing. I'm going to answer your question in a minute, sir. Because you're specializing in goods that have a relatively high value added, broadcasting equipment, telephone, and so on. So the more the blue stuff, the better. Okay? Because that means a lot of value added. As you can see in Cote d'Ivoire, just like in many developing countries. And that's somehow the case in Indonesia as well, for instance. A lot of these exports are actually commodities. It's also oil, rubber, gold. So you don't have much manufactured products, right? And that's a problem because that's through manufacture and high technology projects or services that you generate value added and therefore incomes. So here's a question. What is the NES in the types of goods traded internationally table? Which slide is that, please? Here, NES. Oh, no idea what that is. I have no idea. Product shares in world merchandise exports since. I'm not sure. I'm going to try to figure that out. Perhaps it's uncategorized or I don't know. I'm going to try to see what that is exactly. All right. What else do I want to do before? Yeah, one last slide and then we're going to make a short break. That's net commodity exports as a size of GDP. So this is just to further highlight my point about Côte d'Ivoire, in that as you can, so we're not talking exports to GDP here. We're talking commodity exports. So the ratio is the following: commodity exports divided by total exports. Okay. And as you can see, the more red you are, the higher this ratio. Okay. So that would be the case for African countries because they're exporting mostly um, agricultural products. Russia because of oil. Saudi Arabia and Iran because of oil as well. Mongolia because of copper and coal. As you can see, Indonesia it's pretty high as well because of coal. Australia is pretty high as well because of coal. And as you can see in Europe, it's very small. Why? Because those European countries are importers of commodities mostly. Okay, so in the US, those countries are producing high goods with a lot of value added, not much commodities, right? So that's why it's much lower. Okay, so my point is, it's a good sign where you're either blue or white on this country, just like Vietnam. Vietnam is here, it's blue. So a bit of commodity exports, but not that much. And that's good because that means you're moving towards exporting manufactured goods or services, which are higher in value added, which is going to make the country richer, right? If you export only bananas or mangoes, you're not going to be very rich, right? Because there's not a lot of value added attached to it. Okay. So that's the point I wanted to make. Do you have, guys, any question before we move to looking at protectionism a bit more and then exchange rate determination? All right, it doesn't seem like there is any question, so we're going to make a quick break. We're going to make a 5 minute break today. So it's 21. I suggest we reconvene at 26. Okay, so time for a cup of tea. Talk to you soon. right. Welcome back, everyone. There are two more things I would like to do before we talk about exchange rate determination, uh, which is, first of all, the determinants of international trade from what does economic theory tells you about that. So I want to talk briefly about it, because I'm sure you've heard about it already, so it's just a reminder. Um, there's usually a theory which is well known, which is about comparative advantages, right? Which is trying to explain why some countries are exporting one particular type of goods and importing some other type of goods, right? And it's related to some sort of advantage that the country would have in terms of production costs, either in absolute value, and that's the theory of absolute advantages, or in relative value, and that's the theory of comparative advantages, right? Another way of saying it, that the basis for comparative trade is divergent opportunity cost between countries, right? That is how much you forego by producing one good instead of another, okay? And in particular, nations can increase the consumption of goods and services when they allocate resources to the production of goods for which they have a comparative advantage. That means they are relatively good at producing it. So this may sound a little bit abstract, so I'm just gonna go head on with an example. Okay. First of all, a definition: a country has a comparative advantage in a good when it can produce that good at a lower opportunity cost. That means when it does not cost him too much to produce this particular good. Let me give you an example right here. So how does it work? I'm going to pick a different color. I'm going to pick green, and I'm going to talk about two countries. Okay, we're going to have England and Portugal. Right. So, and we're going to have this graph. On the vertical axis, we're going to have the wine production. You have wine here from 0 to 12 units. And on the horizontal axis, you have the production of clothes. Again, from 0 to 12 units. Okay. So now, assume, so we're going to start with England. Okay, and we are going to describe what we call the production possibility frontier. So PPF means PPF for production possibility frontier. Okay, that's what you can, which is what you can produce at most given your resources. So I'm going to provide a definition here. What country be big enough? What a country can produce must given its resources. Let's look at England, for instance. So if England allocates all its labor to the production of clothes, it will be able to produce 12 units of clothes. Okay. If it allocates all its resources to production of wine, it will be able to produce 6 units of wine. Those are the two extremes of its production possibilities. If you put all your labor in clothes, 12 units, all your labor in wine, 6 units. But you can produce some wine and some clothes. And that's what the PPF tells you, right? You can, for instance, choose something like here, okay? And you would be producing about a little bit more than 2 units of clothes and about 5 units of wine, right? That's what the production possibility frontier tells you. It tells you what is that you can produce at most, that is by employing all your resources in the country. So it can be only clothes, only wine, or a combination of both. And that's what the PPF tells you. Okay. So this line right there is the PPF for England. The idea being, well, in England they are good at producing clothes, but the wine in England is not very good, and you cannot produce a lot of it. Why? Because the climate is not right for wine production. Right? There's not enough sun. I hope there's no one from Britain listening here, but yeah, they have to face reality. Great Britain is a very nice country, but it's not especially sunny. So very hard to grow grapes over there, and grapes of good quality. Perhaps in the south of it, but that's not enough. And by contrast, if you look now to Portugal, and I'm going to pick what color I'm going to, orange. If you look at Portugal, it's the opposite, right? They can, oops, they can, if they allocate all their labor to the production of wine, they're going to be able to produce 12 units of it. Because grapes grow easily in Portugal, it's very sunny, a good climate for wine production. By contrast, the clothes that are being produced in Portugal, they are not that productive, they're not very good. So we assume, for the sake of this example, that they can produce only half of what the British can produce with the same amount of labor. Okay. And again, as with the UK, you can have any combination. For instance, you can produce uh, 8 units of wine and about 2 units of clothes. Okay, you're still on the Portugal production possibility frontier. Okay. So what's the point of doing all this? The point of doing all this is to compare. I'm going to write that here. The point is to compare the allocation or the production in autarky versus international trade. International trade. I'm going to have to rewrite this. Point is to compare production and consumption in autarky versus international trade. Okay. Why? Because assume there is no international trade in this example. Oh, come on. Well, anyway, I hope you remember what I said. Um, assume there is no international trade. So each country will have to pick a combination of clothes and wine on its production frontier. Okay. So for Portugal, that would be this one. And for England, that would be this one. Okay. And they cannot escape this. Okay. And for instance, both production frontier have the 4-4 in common. Okay. That is Portugal and England, because the two production frontier cross at this particular point, we know that if they can allocate their labor in a way such that they will both be able to produce 4 units of wine and 4 units of clothes. How do we know that? Because both PPF crosses this four coordinates, and also they cross each other at this particular point. Okay, so in autarky, that is without any trade between each other, they can reach this sort of allocation in terms of production and consumption. There is 4 units of wine, 4 units of clothes, and that's fine. Okay. But what the theory of international trade, and in particular at absolute advantages, tells you here is that perhaps there's a better way of organizing production here. And what is it? Does any one of you have an idea? What? So, is there a better way to organize production here between England and Portugal? You see, I've done already the autarky situation. I've already explained that both countries can pick anything on their production possibility frontier. I'm just assuming that they're going to, for the sake of simplicity and comparison with international trade, I'm assuming that they're going to pick the 4-4 combination. My question to you is the following. Do you think there's a better, more efficient way of organizing production here between England and Portugal rather than having both producing 4 units of wine and 4 units of clothes? Okay, not much coming my way, so let me make a suggestion, and you're going to tell me what you think. So assume, for instance, I'm gonna clear up everything. I'm gonna pick purple. Assume, for instance, Portugal, which we know is relatively better and is even clearly better than England at producing wine. Assume Portugal produces only wine. Okay. Why? Because with the same amount of labor, they can produce 12 units of wine, whereas England can produce only 6. And assume that England does the opposite. England produces clothes only. Okay, and that means that we're gonna have in total, uh, Portugal, and England will have 12 units of wine and 12 units of clothes to share, right? And here in the example, we just make it such that they can actually have 6 each. You see? Because if Portugal produces only wine, and that means they're going to produce 12 units of wine, and if England produces only clothes, it's going to produce 12 units of clothes. Then what they can do then is trade. And the exchange rate, for simplicity, between the two goods is 1, and that means Portugal can trade 6 units of wine for 6 units of clothes, and they're both gonna be able, in this example, to consume 6 units of wine and 6 units of clothes. Okay, so that means that thanks to international trade, countries can now consume 6 units of, whoops, where's my 6 gone? 6 units of clothes and 6 units of wine rather than 4 units of clothes and 4 units of wine. So to summarize, there are two options in this situation. Remember, we have Portugal and wine. So why Portugal and England? Because it's an example that was used by the famous economist David Ricardo back in the 19th century. Oops, David. to precisely illustrate the gains from international trade. So he took this example. It's a famous example, so that's why I'm using it here. So let me summarize what I've just said. You have two countries, they can produce only two goods, either wine or either clothes. They have a certain amount of labor, the same, but given productivity in both countries, given the climate, given everything, we know that Portugal is better at doing wine than England, and England is better at producing clothes than Portugal. So rather than having each country living in autarky and trying to produce both wine and clothes, there's a better way of organizing production, which is to specialize. That's the key word here. Okay, specialization. I'm going to write it in capital letters. Specialization. Okay, we're going to have Portugal specializing in wine, England specializing in clothes, and then they're going to trade because there's a lot more being produced now. Remember, in autarky, we had England and Portugal producing 4 units of wine, so that's 8 units of wine in total. England and Portugal producing 4 units of clothes, so that's 8 units of clothes in total. Now we have moved to a world in which there are 12 units of each good that's being produced. So there's clearly a gain, and this gain can be seen right here because we're moving from A to C in terms of allocation. Okay? So the bottom line is specialization is good. Okay? Specialization increases consumption possibilities. Okay. So you guys have been very silent on this. Perhaps it's too abstract for you. I'm not sure. But do you have any question? Perhaps you know that already. Oh, and there's something missing here. That's 12. Oh, because we have gone through this. Oh, I didn't know that. Oh, I see. Okay, so that's embarrassing. I'm just repeating something you already know. That's okay. It's just my take on it. So perhaps it's uh, it's interesting as well for you because you have a different way of looking at this issue. So perhaps I should move straight to this idea about exchange rate, right? Um, because that's more specific. No, sir, we even don't know whether we passed the exam. Okay. Anyway, I didn't know that, so I'm going to be careful next year. Okay. All right. So I'm trying to think. So the main point of today, I would like to talk about exchange rates because that's related to money. So that's why I wanted to talk. I thought it would be a good idea to make this sort of refresher on international trade. So what I suggest is that I move forward now, unless you have a question. I'm just going to briefly talk about protectionism and international trade restrictions, and then we're going to talk about exchange rate. Is that okay? Okay. Um, okay. So let's do that. So so in the story that I'm telling you, so we've seen the determinants of international trade. I've shown you some statistics, some data, shown you how this has evolved in the 20th century that has massively increased due to falling transportation costs, due to discussion rounds at the international level to decrease the average tariffs. Okay, and why it's important to talk about tariffs, because public policy protectionism can have an impact, obviously, on international trade. We've seen that. That's one of the two main reasons why international trade increases. So what I want to do before talking about exchange rate is briefly remind you a little bit about protectionism. So that's what we're going to do today. And I'm going to try not to spend too much time on it, especially if you've already worked on that. So despite the fact that free trade generally promotes grain from grain, trade is still restricted, right? A classic argument for restricting international trade are that protection is needed too. These are the four main reasons to motivate and justify protectionism. First, there's establish an infant industry. Second, counteract dumping. Third, counteract other countries' protectionist measures. And four, counteract other countries manipulating their currency. So I'm going to review each one of these arguments one by one and give you my view on this. But the starting point is to realize that actually specialization and trade is good, right? The starting point is it's important to remember. Starting point, specialization, international trade is good because it allows to allocate production across countries efficiently, right? In my previous example, it's efficient to have Portugal do wine only, and it's efficient for England to do clothes only. Okay, so that's the starting point. So every time you talk about international trade, there's this idea at the back that we should encourage specialization to make sure that the countries that are good at some particular goods and services, they do it, and they forget about producing the stuff they're not very good at. Let me give you a silly example, but that would be very silly for Vietnam to try to build an international ski station, right? Why? Because it's a very nice country, Vietnam. It's goddamn too hot, right? So you cannot ski. I think in the northern part of the countries you have snow in the winter, right? But I think it's very brief. There's not that many slopes, whatever. So it would not be a good idea to have a ski station in Vietnam. However, producing electronics or some other commodities can be good. By contrast, in Germany, Switzerland, and France, you have the Alps, so you can have a ski station. Yeah, that makes sense. Okay, so that's a very simple way of putting this. So my point is the following: the starting point is specialization in international trade is good because it allows to allocate production efficiently. Okay, but there are a couple of examples, actually, four reasons why sometimes protectionism is good, and that's what we're going to study now. So the first is the infant industry argument, which goes like this. The infant industry argument is that it is necessary to protect a new industry from import competition to enable it to grow into a mature industry that can compete in world markets. Yes, for instance, if you take a country like Korea, South Korea, it has now developed a lot of specialization in cars, in shipbuilding, for instance. Well, you don't build those industries from scratch, right? There is no initial God-given comparative advantage in car producing or shipbuilding. You have to build it, right? You have to accumulate the capital, the skills, the manpower to build this industry and make it mature and competitive on the world stage. Okay, and that's exactly what Korea did, right? They helped build those industries from scratch. It was not only driven by private initiatives and private entrepreneurs, right? The government was here to push and help build this industry. We had the same in Europe, for instance. If you look at Airbus, okay, Airbus was a consortium first, was a group of government that decided to say, oh, all right, we're going to have a space industry. Okay, but France could not do it alone. Germany could not do it alone because it was too expensive. So they decided to get together, pool resources, human resources, financial resources, and build this industry, right? So the reason I'm saying this is because you don't want to be too naive with this view about international trade, right? Which would be on some natural, God-given comparative advantage. That's not the way it works. Okay, you can build comparative advantage. You can build absolute advantage. Okay, you can build a good specialization, and that's what some European countries did. That's what Korea did, and perhaps that's what Vietnam could try to do in some high value added industry. Right? You don't want to be stuck forever in a low value added industry. Okay? I'm not saying this is what Vietnam is doing. I think if you look at the data I've shown you before, Vietnam has, at least compared to some African countries, for instance, has specialized in some high value added goods. So that's a good step forward. It's not perfect. We know that in some of those factories, things very are not optimal for the people working in there. That sometimes the work conditions can be very tough, but at least it's moving in the right direction. Keep in mind, many of the rich countries nowadays they went through a similar stage. And if you look at the working conditions in France in the 19th century, was not especially nice, right? It was not especially good. Children were working in the mines. They were working long hours as well. So, but sometimes I'm not saying it's a necessary step, but it's a stage, right? And as the sooner you escape from this stage, the better. But that's if you want to build this sort of industry, you need to go through these early stages of development. Okay. So bottom line, this infant industry argument I think is a valid one. If you take any African countries, for instance, rather than being selling agricultural products like coffee or bananas or whatever, which are not high in value added, perhaps they should try to build some high value added industry. That's what the infant industry argument is all about. Second reason, the dumping argument. Dumping occurs when a foreign firm sells its export at a lower price than its cost of production. Right? Dumping is seen as a justification for a tariff to prevent a foreign firm driving domestic firms out of business and then raising its price. Okay, the idea is that it's simple. Sometimes firms are cheating. They are trying very hard to enter your market. And how do they do that? They're selling their goods below production costs. So that makes them very cheap, and it's very hard, therefore, for domestic producers to compete. And that's unfair. Okay? Because if a company does dumping, it makes it very difficult for the domestic firms to compete, and it can even drive them out of business. Okay, so typically that's what firms that do dumping are trying to do. They're dropping their prices, trying to force competition out, and when the competition has disappeared, they move prices back up. Okay, that's very bad. That's illegal, by the way, but because it's very hard to prove that some firms were selling below the production cost, it's also very hard to prove that some firms are doing dumping. So when there is dumping suspicions, it's and you have good reason to believe that one firm is doing dumping, then it's a good idea to impose a tariff on those goods, right? Just to protect your domestic industries, because this is not fair competition. This is not regular competition. You're not trying to gain market shares because your goods are better. or higher quality, you're trying to gain market shares by cheating, by selling below production costs. So because it's uncompetitive practices, because it's illegal, it's perfectly justified for government to raise um, uh, tariffs in that particular case. Some people say that its argument is flawed because it's impossible to determine a firm's cost, so that's right. So you would see sometimes governments use this dumping idea as an excuse for imposing tariff, because it's very difficult to prove that a firm is doing dumping. So you could just say it without any uh, evidence and then impose a tariff. So you have to be careful with that as well. Okay. And also when you have a natural monopoly, which means when you're in a situation when your production decreases with the quantity produced, it's always more efficient to have just one firm anyway. All right, so that's the second argument. So here I'm just reviewing the argument in favor of protectionism. There's the infant industry argument, there's the dumping argument. And third argument is government restrict international trade to protect domestic producers from competition by using three main tools. Okay. So there was a third argument which I haven't talked too much about. Perhaps I can. I said there's infant industry argument listed right there. We've seen this. We've seen this. These two. The other one you are perhaps easier to understand is simply when a country in, is setting up protectionist measures, then well, why would you not do the same? Right? Um, it's it's also one of the main reasons to justify imposing tariffs on some other countries. If they are imposing tariffs on your goods, why would you not do the same? Okay, as a retaliation. So that's another argument in favor of protectionist measures. You don't want to be the only country that is not imposing tariffs if others are. So that's the third one. And the last one is to counteract other countries manipulating their currency. That's another form of protectionism. Right? Remember what we said about when we talked about sterilization operation. Remember what I told you about the People's Bank of China? In China, the Chinese government is not very comfortable with the idea that the Chinese yuan should appreciate. So they're always printing new Chinese yuan to buy foreign currencies in order to prevent the yuan from appreciating too much, which would be the natural thing to do because they're running a trade surplus. And that's currency manipulation. Okay. And this is not a good thing, right? Currency manipulation. Remember, that's in the case of it's not as bad as it used to be, but China is preventing the yuan from appreciating. It's bad for two reasons. First, it's interfering with market mechanism, and the fair price of the yuan should be reflected by supply and demand. And second, it's bad for Chinese households because if the Chinese yuan was more expensive, then it means that Chinese household could buy more foreign goods, right? Because the value of the currency would buy more of the other currencies, so they could buy more goods from outside of China. But if going back to our problem, which is protectionism, well, it is a form of protectionism because you're preventing your currency from appreciating, and therefore you're preventing the price of the goods that you're exporting from rising. For instance, in Europe or in the US, central banks are not trying to influence their exchange rates. Right? So in that case, and in that last case, I think a lot of economists consider that it would be justified to set up some sort of protectionist measures because there is currency manipulation. Okay, uh, so that would be justified in this case. Okay, so I'm gonna go back and finish by listing those various different protectionist measures. So here they are. We talked about tariffs already. We talked about quotas already. And subsidies is just helping domestic industries. Help, so financial help to domestic industries. Um, this is a form of protectionism in the sense that if those firms were not receiving help from the government, probably they would disappear because they are not very competitive. And we have a lot of stories in international trade about this. At some point, countries trying to help some industries protect them from foreign competition by subsidizing them. Um, well, it can very often turn out into a disaster, right? Because if the government is helping the company, that means the firm is not very good, is not pushing itself to improve its productivity or the quality of its product. So perhaps that company should just disappear and the resources being allocated into a different industry. Um, right. So on here you have all the definitions, so I can read them again. A tariff is a tax that is imposed by an importing country um, when an imported goods crosses its international boundary. A subsidy is a payment made by a government to a domestic producer based on the quantity produced. Not only, but that's one part. And quota is a limit on the quantity of a good that may be imported. All right, history of tariffs. I think I'm going to skip that because we already talked about it. When we talk about this, those reduction in trade barriers. You see, when I talk about the euro rounds, okay. After World War II, you had many rounds of discussion, international talks, precisely to coordinate on reducing international tariffs. So I don't think I'm going to skip that because otherwise I will not going to have enough time to talk about what I wanted to talk today, which is exchange rate determination. Okay. Right, so I'm going to skip that. You can read that part. It's mostly refreshers about the history of trade discussions. All right. So let's talk about the determinants of the exchange. Unless you have any question at this stage. For instance, right, all right. It looks like there's no question, so we're going to look at the exchange rate determination. Okay, so international transactions are influenced by international prices, right? Remember that's what we said at the very beginning of this class. So, and international prices in particular are influenced by the exchange rate. So that's what we're going to talk about. The nominal exchange rate is the rate at which a person can trade the currency of one country for the currency of another country. So that's easy. All of this is done on the foreign exchange market, which is the market in which the currency of one country is exchanged for the currency of another. And this is a huge market, right? And this is some important figures. You have 5.3 trillion dollars that are being traded every day on this market. So uh, that's 5.3 million, 5.3 billion, 5.3 trillion. That's the amount of the that's the amount of dollars that are being traded in terms of that's let me rephrase this. That's the amount of foreign exchange transaction measured in US dollar every single day on the foreign exchange market. So it's a big market. Okay. Some piece of vocabulary here. We're going to talk about an appreciation. When there's an increase in the value of a currency as measured by the amount of a foreign currency that it can buy. And conversely, we're going to talk about the depreciation, where there is a decrease in the value of a currency as measured by the amount of a foreign currency that it can buy. Okay. So appreciate means your currency goes up, can buy more of other currency. Depreciation means the opposite. Let's have a look at the Vietnamese dong from 1988 to 2019. So as you can see, and I'm sure some of you remember that, the Vietnamese dong used to be able to buy in the 14,000, not the US dollar used to be able to buy 14,000 US Vietnamese dong. So there was a slow depreciation. Then right after the 2008 crisis, you had a much faster depreciation of the Vietnamese dong. Why is it a depreciation? Because you can buy more Vietnamese dong with 1 USD. So that means the US dollar is appreciating. Therefore, the Vietnamese dong is depreciating. So you had this big depreciation of the Vietnamese dong, which we're talking 2008, and it stopped in 2000. Within 3 years, the Vietnamese dong dropped from 16,000 to 21,000. So pretty fast depreciation. And then some sort of stabilization since then. It's been a slow depreciation. Let's have a look at the exchange rate today. USD VND. It's 23, a little bit more than 23,000. So you can, it's a little bit, it has depreciated a bit more, but not that much. So you see, since the late 80s, three phases: slow depreciation, fast depreciation, and another slow depreciation. Okay, that's for the Vietnamese dong. Let me ask you a couple of questions now. First of all, do you think a currency can appreciate and depreciate at the same time? Yes or no? Here is a poll for you. Do you think a currency can appreciate and depreciate at the same time? Can you see the result of the poll live or can you not? Because I can see the live result. That's fun. So we have 13 answers. 14. So that's the first question. Do you think a currency can appreciate and depreciate at the same time? All right. Keep it up, guys. Keep the answers coming. A few more and we'll be good. All right, so let's stop there. So we have 12 yes and 5 no's. So actually the answer, the correct answer is yes. A currency can appreciate and depreciate at the same time. Why is that? Well, for instance, the USD can appreciate against the Vietnamese dong, but depreciate against euro. Okay? And that means that the euro appreciated against. It has to be the case, right? All right. Yes, it's possible. Your currency, one currency can appreciate against another currency for some reason that are specific to perhaps to the relationship between these two countries, and it can depreciate against the currency of another country for some other reason that are specific perhaps to the relationship between these two countries. Okay, so the answer is yes. Okay, but I'm happy to take a comment or a question here. Perhaps, whoops, perhaps because at least 5 or 6 of you answered no. So, my goodness, it is. A comment or a question? Is it all good? I mean, it's like in a horse race, for instance, right? There are 3 horses, one that is running very fast and one that is running very slow. So, no, that's not a good example. Forget it. But no, I can see one of you is typing, so I'm going to wait for the answer to show up. Okay. The comment is coming or a question, so I'm waiting for it to show into the chat before looking at the other question. Can I ask about your comment previously? Why did US appreciate against VND during the crisis? Yes, of course you can. So typically, and that's very general, it's not specific to the 2008 crisis, but when there is a world financial crisis, investors, and in particular investors from rich countries, are moving their money back into their own country or into some sort of safe haven or safe place. Okay, I'm going to write that here. During a crisis, investors are moving their money back into their own country or into assets that they consider safe, right? Why? One reason being they expect uh, the currency of developing countries to depreciate. So you don't want to be invested into Vietnam if you expect the Vietnamese dong to depreciate, right? Because if you have invested money in the Vietnamese business or in the Vietnam stock market or in Vietnamese bonds or whatever, even if you're doing good money in Vietnam, once you convert it back into US dollar, if the Vietnamese dong has depreciated, then you will be losing money. So that's why every time you have some sort of big crisis that hits the world, the currency of developing countries are really depreciating rapidly because investors from the US, from Europe, but also from Asia are withdrawing their investment there. Okay, so in a sense, it's self-fulfilling. I'm going to talk about that, not self-fulfilling, because because they're afraid it's gonna turn into depreciation, and because they're selling the Vietnamese dong, it does turn into a depreciation. So let me look at your comment. Can I ask you about your comment previously? Why did US appreciate again? For the reason, sell US dollar, buy US dollar increase to get back money. Vietnamese don't depreciate. Buying USD increases, hence US appreciate, get back their money. Yes, that's right. That's what I've written on the slide, right? When there is a crisis, people want to park their money into safe assets, and they consider that developing countries are not safe assets. So typically, you would see that they're happy to invest their money when there are good times, right? We know that the rate of return on capital in developing countries is higher than in the developed countries, but the risk is mostly associated with the exchange rate, right? If the currency depreciates, then this can do a lot of harm. So they'd rather remove the money as soon as they fear there's going to be a crisis. Okay. So did I answer your question? Someone is typing, so I'm waiting for the comment or the question to show up. But at that time, Fed pumped trillion USD via bond market. So which currency appreciated again? That's a good point. The Swiss franc did. Mhm. The Swiss franc. We can look at the Singaporean dollar. Probably did as well, because Singapore is considered like the Switzerland of Asia. But that's a good comment. I mean, the US was pumping trillions of US dollar, and still the Vietnamese dong was depreciating. That sounds crazy. It's not crazy. You have to remember that by comparison to the US, the Vietnamese economy is very small. Remember, the Vietnamese GDP is about 300 billion, right? US GDP is about, I think it's not, about 20 trillion. That's 20,000 billion. So if you make a quick calculation, the Vietnamese GDP represents 0.15% of the US GDP. So if you remove money, massive amounts of money from Vietnam, it's going to have a big impact. Another way of saying it is that the USD VND market is not very large. Okay, so if you remove a large sum of money within this from this market, it's going to have a huge impact on the VND, right? But by contrast, the USD Euro market is much larger. So buy and sell orders on the USD Euro market will not have that big an impact on the bilateral exchange rate compared to USD VND, right? It's a tiny market in a sense. So if you remove a good chunk of money from Vietnam, you need to find people that are happy to buy your Vietnamese dong, right? So you need the price has to drop, right? That's the idea. Yeah, I understand. Thanks, Prof. The small and emerging markets hurt the most. Yes, it is, and that's unfair. I mean, the US are pumping trillions of dollars, so you would expect their currency to depreciate. They're not. Why? Because they have a lot of firing power, right? And they are big economies. Big economies. Keep in mind, the USA is about 20% of the GDP, so it's huge, and it's 60% of market cap. Capitalization. Capitalization. So whatever happens, well, I mean, when this guy decide to move money around, I mean, you better be prepared, right? And it works both ways. I mean, if suddenly everyone thinks, oh, Vietnam is the place to be, I want to invest my money in Vietnam, you can have a huge appreciation of your Vietnamese dong, right? So it works both ways. During crisis, the Vietnamese dong will depreciate. It's perfectly possible, although the graph does not show it here, that the currency will appreciate during good times. Perhaps not for Vietnam, but for other countries. I told you about Switzerland, for instance. You told me, you asked me which currency appreciated against USD at that time. The Swiss franc did. And again, Switzerland is a tiny economy. The Switzerland GDP is I think it's 650 billion. So it's a bit more than twice the size of the Vietnamese GDP, but it's still very small compared to the US GDP and the world and the European GDP. So the Swiss franc appreciated very dramatically right after the financial crisis. And that was that made things very difficult for Swiss exporters, right? Because it's a tiny market. The USD Swiss franc is a tiny market. So when you have trillions of billions of, perhaps not trillions, but billions of USD that are moving into buying the Swiss franc, I can tell you that there's not enough supply. So the Swiss franc has just shoot up, and huge impact for Switzerland, right? So it was both ways. So that's the problem with tiny economies. The, the foreign exchange market for their countries is not very deep, so it's very hard for them to absorb the shock. One last comment, and then I'm going to take your question. So it can be so bad that some countries have just they do capital control and they do not let their currency being determined on foreign exchange market. And that's the case for Mongolia, for instance. Mongolia is such a tiny country. It's bigger. It's 2.5 the size of France. Mongolia, it's 2.5 the size of France from a land point of view, but they're not even 3 million people there. It's very small, so they cannot afford to have their exchange rate determined on the foreign exchange market because there would be huge spikes. So they've decided I'm not gonna. They have closed their foreign exchange market. So only Swiss franc absorbed that shock. Not only Swiss franc, Swiss franc. Actually, and not an exclamation mark and a question mark. It's not only Swiss franc. The USD appreciated. It's crazy, even though they were printing trillions, billions at time. Why? Because it was still considered a safe asset. I know it sounds insane, but during the 2008 financial crisis, even though they were printing billions of USD, the USD was appreciating precisely because um, it was still considered as a safe asset, a safe currency. It has depreciated since then because little by little operators started to realize that actually um, perhaps there was too many dollars floating around. But right after the 2008 crisis, the USD was appreciating, just like the Swiss franc. Check out the Singaporean dollar, whether the same happened to it. Probably. So it's a bit of a paradox, right? Well, then the rich become richer. Yes. Come to life. Okay, yeah, that's usually the case. Yes, but yeah, I guess you can tell you that. But it's doing. I mean, a sharp depreciation of a currency can do a lot of harm as well, if not much more than currency depreciation. Why? Because it hurts exporters. Right? And in Switzerland, it's a very, just like Vietnam, perhaps not as much as Vietnam, but it's a very open economy. So when the domestic currency appreciate, that makes like very difficult for the Swiss exporters. So it's not so when you say the rich become richer, it's a valid comment, but it's not that for the USD. Yeah, it hurts US exporters as well. I mean, you can say that as well. So um, yeah, to the extent that it's an importing country that makes imports cheaper, you're right. But it will impact exporters, and you have quite a few people exporting in US as well. Remember the statistics that I gave you for the bilateral trade before China and US. I told you on average China sells for about 600 billion USD to the US, but the USA are selling about 250 billion US dollar to China, which is about the size of the Vietnamese GDP, by the way. So yes, you have quite a few exporters in the US as well. It's not because they have a trade deficit that they are not exporting goods, so it is harming them. But in a sense, you're right. It's a little bit unfair, but we're talking economics, so this is what it is, right? When there is a crisis, people remove their money from places that they consider are risky places, and they move it back to what they consider are safe places, Switzerland, the USA. Okay, but as soon as things go back to normal, then the money will start flowing out again, and they will invest their money again um, into developing countries, and the Swiss franc should depreciate, and so on, and the USD should depreciate. The USD has depreciated, at least against the euro, quite significantly recently. Perhaps because things are normalizing, or also because there are too many euros floating around. Right? But those were good questions and good points. So I'm always happy to take this sort of question. Any other question? We haven't been able to talk about exchange rate determination, unfortunately. So we're gonna do that tomorrow. Before I think we're gonna do that tomorrow before the test. Right? So tomorrow, so let me clear that up. Tomorrow we're gonna start by answering this question. Then I'm gonna finish the slides. How many do we have left? Yeah, we have about 15 slides left. So program for tomorrow. I'm gonna write that here. Program for tomorrow. Finish those 15 slides on exchange rate determination. Then we're gonna do the mock exam plus answers. And we're gonna have the Q&A session. Q&A session. And for the time left, we're going to look at some aspects of the Vietnamese economy. Right, that's the program for tomorrow. Okay. I can see that someone is typing, so perhaps there's another question coming. So we shall skip session. No, we'll not skip it. Session 6 is about some aspect about the Vietnamese economy. Right? You look at the title of section 6. It's called the Vietnamese economy, recent development and outlook. So no, we will not skip it. We're gonna have enough time, I'm sure. All right. any question on what we've done today? All right, it looks like there is no question. So then it's time for me to thank you for your attention. And we're gonna reconvene tomorrow, same time. And you have the program on your screen right there, okay, for what we're gonna do tomorrow. All right. So thank you very much, and see you tomorrow. You're welcome. Thank you, and have a good night. I still have my evening. You don't. So have a good night. Right, I'm gonna end the recording now and save the share notes.